What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series where I use all of the current market volatility to find you guys 3 new stocks every episode that I think are on sale at today's prices for the long term. And to make things more fun and interesting, I specifically look for one low risk, kind of very large dominant stock, one medium risk dividend stock, and one high risk speculative stock so that you get an even wider variety of risk versus reward depending on what type of investor you are. As always, though, just keep in mind that I only do this for fun to give you guys an idea of what type of stocks are available out there in the market. So please do your own research, make your own decisions. I'm not telling you what to do. I'm just sharing my thoughts. And if you appreciate this series, if you appreciate me trying to find you guys different stocks every time, then please consider hitting that like button and subscribing to the channel, as those 2 things really help this channel survive and grow, and it means a lot to me. But with all that said, let's jump into today's fresh new list of stocks. Okay, and as always, we'll be starting first with our low risk option, a very dominant company that is likely to perform well over the long term because of their large size and strength. And this time I'm going with a stock that I actually own myself in the Chinese e-commerce giant Alibaba, ticker symbol BABA. And I already know what you guys are thinking. How could I possibly consider this one low risk when it's a Chinese stock that holds very little ownership rights for foreign investors because of their VIE structure that basically means you own a shell company clone rather than the actual company itself. And of course, there's also significant risk coming from the rising tensions between the US and China, not to mention the communist Chinese government itself that exudes power and control over most companies in the country, which at any point they can regulate into the ground or decide to ban foreign investment or do a number of other things to really damage these investments for us foreign investors. However, the reason why I still consider Alibaba to be somewhat low risk today is because, well, I don't personally think that any of these worst case scenarios will ever materialize for Alibaba. And if that's the case, then you're talking about possibly one of the absolute best stocks to own in the entire market at today's prices. Now, why do I feel that way? Well, for one thing, China was a country in severe decline before they opened up their markets and started adopting more capitalist practices. In fact, their poverty rate used to be higher than 90% until they started adopting a more market friendly economy in the 90s that sent the poverty rate all the way down to the teens today. Of course, there are still horrible practices that go on in China all the time, but what we know for sure is that economies in general almost always perform better the more open that their markets are. And knowing that China has ambitions of being the largest superpower in the world by 2050, well, they're going to need to have that type of economy, that type of market, and they're also going to need their largest companies like Alibaba to be successful over the long term. Take, for example, their American rival in Amazon, who already does around $500 billion in sales per year just as a standalone company alone. Well, if China wants to have their own version of that to compete on a global scale, Alibaba will likely be their best bet. First of all, China is already the largest market in the world with over 1.4 billion people. The only other country above a billion is India, and then everything else is just around 300 million or less. And with that massive population comes the largest online retail market at more than 3 times the size of the next closest country, which, by the way, is the United States. And yet, online sales only make up less than a quarter of all retail in Asia. So that market is only going to get even more massively large over time. So where does Alibaba fit in all this? Well, you're talking about by far the most e-commerce market share in China at nearly half of the entire market. You're talking about by far the most cloud computing market share as well, and the fourth most cloud market share in the entire world, only behind other behemoths like Microsoft and Google, and it's also a huge play on the future of artificial intelligence. And you're also talking about giant financials that, when converted to American dollars, is usually north of like 100 billion in sales and 30 billion in operating cash flow that they're using to expand their already massive business even further into new ventures like electric vehicles, gaming, the metaverse, the still larger brick and mortar retail market, and much more. Unfortunately for Baba, though, Their business has been beaten down both directly by the Chinese government in the form of regulations and fines, as well as indirectly in the form of pandemic lockdowns and supply chain disruptions that are crippling the macro economy. And having to come off of such explosive growth of over 40% in 2020 and another almost 20% last year, Baba is now seeing their revenue growth come to a screeching halt of only around 4% expected this year before recovering to a double digit percentage next year. That alone, though, coupled with the stricter investing policies from the United States, have been enough to crash Alibaba stock into the ground, leaving it now trading even lower than their pandemic lows and down a mind blowing 70% from its highs. Alibaba remains a risky stock for some because of the valid concerns that I've mentioned, but for others, myself included, I actually consider it to be somewhat low risk at these levels. And I think that it has the potential to more than double over the long term from here. In the short term, it'll likely remain extremely volatile for some time, so I do still exercise caution and I limit my buying so that I'm not overly exposed to any Chinese stock, little, not Alibaba, not any Chinese stock. But with a forward PE ratio of only 11 and a price to sales ratio of only 2 for one of the world's largest, most dominant leaders in several areas, yeah, I would say, in my opinion, it definitely looks undervalued right here. Okay, moving on to stock number two, though, that's going to be our medium risk option that includes a dividend to help lower the risk a little, since a falling stock price does mean a rising yield in most cases. And this time, I'm going with a stock that I have never owned myself. In fact, I've never even talked about them on the channel before, but I'm starting to really like them a lot, especially for the type of business they have. And that is American Tower, ticker symbol AMT. Now, this is actually a real estate investment trust, which are companies that own real estate and various assets. Then they collect rent or fees on those properties, and then they pay that income out to investors, usually in the form of like a very attractive dividend. However, with the whole retail apocalypse that's been going on in recent years, coupled with the pandemic that forced buildings to close down and many businesses to go bankrupt and out of business, and a literal macroeconomic recession that we are currently in, well, many REITs have seen their businesses get destroyed, making their stocks much less attractive during these difficult times. However, American Tower is different in that their properties include cell towers that are leased out to mobile carriers like AT&T, Verizon, and T-Mobile, so that you get a wireless connection on your smartphone. All three of those, by the way, they've all recently signed new multi-year long-term contracts with American Tower. And I don't know about you guys, but if anything, I've only seen even more people use their smartphones throughout the years, even during these crazy times, which is a trend that I think is very likely to continue and get even bigger over time. And some of that growth, by the way, in smartphone usage has been fueled by the rollout of 5G, which is a generational upgrade that should always be taking place well into the future as the world becomes more and more wireless, requiring better connections with higher speeds. And American Tower can definitely be there to power a lot of that. In fact, their sales have actually soared by over 16% last year because of it, and are still projected to soar by another 14% this year as well, even with the weak macroeconomy. Granted, they're expected to slow down to a mid-single digit percentage after, but profits should still continue to rise, with EPS growth expected to average double-digit percentages throughout the next 5 years. That's in large part due to the fact that their service will always be needed by these large carriers, and once they build their equipment on AMT's towers, it's very expensive to remove them and switch to a different provider. Thus, American Tower benefits from long lasting contracts with only a tiny churn rate of usually around just 2% on average, meaning leases that are not renewed. It's very small. That's expected to go up a little in the coming years, though, because T-Mobile is eliminating the Sprint network due to the merger, but that's also why AMT's growth is expected to be, slower than usual. Longer term, though, wireless data usage is expected to nearly quadruple in size just from 2020 to 2025 alone. Much of that growth will also happen internationally, and as the largest communications rate in the world with over 220,000 sites across 6 different continents and 25 different countries, I think American Tower stands to benefit from that just as much as anyone. And thanks to their super low churn rate, coupled with the fact that they have the ability to add multiple carriers to individual tower sites once they're built, AMT is able to benefit from some actually pretty large margins too. Last year, for example, over a third of their sales went straight to free cash flow profit. And those profits are being returned to shareholders in the form of dividends with over a 2% yield and a high growth rate. But despite the positives of their stable business, the macroeconomy, along with the broader market, have caused the stock to sink recently to the bottom half of its 52-week range. This is a pretty slow-moving stock, which makes sense when you consider the slow but stable business. But sometimes you see a fairly large dip in the price, like you're seeing right now, which has caused it to fall by close to 20% from its highs, making this probably a decent time to be picking up the stock and holding long term. Literally, the only issue that I have with American Tower, though, and the only reason why I've never purchased it myself, is because of the rich valuation. Their trailing P ratio is currently sitting at over 40, which is just too rich for my blood. However, AMT has always been an expensive rate because of the reliability. And even now, with the large dip, they're actually trading significantly lower than their 5-year, 10-year, 15-year, and even 20-year averages. Personally, my gut tells me that this is probably a good time to pick up the stock on the dip, but I think I'm going to wait just a little bit longer to see if I can get a slightly higher dividend yield, since, a little over 2% is still a little small. But on the other hand, it's actually at some of the highest levels that we've ever seen for the stock. So it's probably at a good level even here. All right, guys, that's going to leave us now with the third and final stock of the day, which is also our high risk option. And for this one, I'm going with another stock that, just like American Tower, I have never owned it myself and have never even talked about it on the channel before, but it's definitely catching my eye a lot right now, and that is Upstart Holdings, ticker symbol UPST. Now, this one is extremely high risk, but it also offers quite a lot of reward potential if things can get back on track. A little bit of background though on who this is and what they do. Well, Upstart is a fintech company that is trying to disrupt the traditional credit ratings and money borrowing markets by using artificial intelligence to factor in a larger amount of data and criteria when trying to grade a borrower and figure out if they would actually pay back their loans or not. This broader and deeper analysis of credit means that Upstart is able to find more borrowers that would otherwise get rejected, while also decreasing the amount of delinquencies for the banks and lenders, which is pretty impressive. At which point, Upstart is able to charge a fee for connecting those lenders with better screened borrowers and by a larger amount. Now, initially, Upstart did see a lot of success with this business model, as you would expect, as they were able to lower interest rates by 43% when compared to traditional credit scoring models, which attracted more borrowers to take out loans and thus increase their fee revenue. See, Upstart claims that 80% of borrowers have never even defaulted on a loan, yet less than half of them ever gain access to prime credit because of the outdated credit rating models. But thanks to Upstart's new, AI focused system, well, they're able to give more access to more borrowers, including minorities, by the way, who saw a 43% increase in approvals among blacks with 24% lower interest rates, while also increasing Hispanic borrowers by 46% at 26% lower interest rates too, which are staggering statistics. And as a result, Upstart's revenue can sometimes skyrocket by giant amounts, with 2021 seeing growth of close to 300%. The issue, though, is that a ton of that growth was because of pandemic stimulus that got pumped into the economy, which resulted in higher lending. However, the other result of all that money printing has now been record high inflation that is destroying the economy and leaving us in recession. On top of that, we are trying to deal with that inflation by raising interest rates. Well, if you know anything about recessions and rising interest rates, well, it's that people stop paying back their loans on time during those, difficult times. As a result, Upstart has seen their delinquency rate more than double in just 1 year. And because of the super hard comparison to 2021, where financials were lifted by that stimulus money, well, their sales are now only expected to climb by a low single-digit percentage, which may even be too optimistic even here and leaves room for disappointment to the downside, which can sink the stock even lower. Speaking of which, as a result of these concerns, what was once a skyrocketing stock following their 2020 IPO that rose to over $400 a share has now been absolutely destroyed, crashing by over 90% and falling all the way down to just the $20 range. That's pretty freaking crazy. Now, in my opinion, I think a lot of that crashing was justified because the valuation was absolutely ridiculous, while their business model is still too young to know for sure that it can perform well enough during difficult economic conditions like the ones that we're in. However, at these levels, I gotta admit that it's getting tempting to bet on. At one point, their trailing PE ratio was astronomically high at over 800. Today, while not exactly cheap, it's at least much more reasonable at 28. And their price to sales ratio was also extremely high at over 50, but today it's just less than 2. That's pretty damn cheap if they're able to grow anywhere close to as high as they used to. And yeah, currently the economy sucks and it's going to be hard for Upstart to grow under these conditions, not to mention that there is a very real concern about an even larger recession being just around the corner, at which point Upstart will probably continue to crash. They probably won't meet expectations, even the small revenue growth that is expected, and yeah, the stock can fall even further than it already has, if those things happen. But when things finally improve in the macroeconomy and the stock market begins another bull run, we might be looking at a stock here that has multi-bagger potential. And as high risk as it is, and as much as I do consider them to be highly speculative for many reasons, at least they've already proven that they can be profitable, doing over $100 million of net income last year alone. I don't own it myself yet because, like I've said many times in recent videos, I just own way too many spec stocks at the moment. But this is really a stock that I really want to keep researching further, because the more that I learn about them, the more that I feel like I might just want to swap out one of my already existing spec stock positions and bring in Upstart instead. Especially the more that it falls, I think the more interesting it becomes. But let me know what you guys think. I'd love to hear your thoughts about Upstart. It's a new stock that I've been researching myself, so I'm still kind of new to it, but I'd love to hear your opinions down below. And is there any other stock on this list that you liked, that you're invested in already, that you're thinking about? Or are there any other stocks that you think should be included in a future episode? Let me know down below and I may include them. But thank you so much for all the support and for watching my videos. It really means the world to me, and I hope you're all doing well, and I will catch you in the next one. Take care. Bye-bye.